how do you define risk beyond just volatility or drawdown?
With family capital, the risk is always a lot at a human level. Conversations that take place in the family internally after that event has happened. You either get lost in the storm or you have enough data and awareness to sit down and rewrite your own rules. Do not confuse a single family office with an investment fund. And if it's come to us, then it's definitely been rejected by a lot of people.
How do you adapt your investment portfolio across geographies?
Without the right back office and the right tracking, you might be the smartest investor, but you'll be the worst family office investor.
Hi, welcome to another episode of Inside the Family Office, where we talk to family office principals and try and bring actionable insights to you. Today, I am in conversation with Yash Poddar, investor and co-founder of Viansh Ventures, a single family office set up in 2013, set up at a time when structured family offices in India were still evolving. And what makes Yash's journey distinctive is that his own investing career developed alongside him structuring their family office. He has taken discretionary calls across listed equities, private equity, and commodities. In recent years, he has also been guiding a lot of newer families on wealth structuring, governance, and forming their investment policy frameworks. Welcome, Yash.
Thank you so much for having me.
Let me start on a philosophical note with you. Managing a family office is a truly long-term journey. What do you personally define as success?
When I think of a single family office, there are two forms of successes that I measure. The first success is looking at the entire corpus and figuring out whether we are meeting our investment objectives or not, which means that it's a quantitative answer. And when I look within the family office, the real success that defines our day-to-day lives and that actually affects each member of the family are the personal goals of the family members. So each family has a different bunch of generations working together. And like any family business, a family office must ensure that every individual within the family is having their own goals met. And that goal could be either creating a new business or a new project. It could also be self-actualization goals, which go much beyond investing in numbers. And when all the objectives come together, not just solving for the quantitative return, but also the life returns of the people that are involved in the family, this also takes into account the emotional needs of family members, the requirement that goes for various facets of life, whether it's education, health. Now, in a large context, a lot of this might already be addressed. But for most family offices, the trouble begins when the next generations come in and they want to figure out how they want to move that same boat ahead. And so, real success, I'm sure different families would have a separate metric depending on what they're allocating their assets also upon. But for the most part, it is actually to do with each individual coming together and being able to communicate freely and achieving things that go beyond money. But the problem is that the words family office and investment fund seems very synonymous with each other.
They seem to be
So-
synonymous, but family office is beyond just investments, right? There's
Yeah.
succession,
Yeah.
there's estate planning, there's just so much more.
And these are all things that which don't only have to be formed once, but they have to be regularly refined and tuned with time. Now, you might argue that these are one-time activities and they don't take that much effort, but the reality is that these things have to be refined and bettered with time, which also means that the awareness amongst the family members of why we are doing this have to be equally important. So it's not just returns, it's not just money, it's not just about picking a product. It's being able to be maneuver around a larger platform of what you want to do.
So, Yash, let's talk about some of the early mistakes which you think helped you actually meaningfully change how you take investment decisions.
So when we started out, we began a journey of learning about what really means to be investing in the market. Couple of mistakes that we made early on, which we're very happy about in hindsight. First part was about understanding cycles. when we enter the markets, a lot of the feed that was coming into us was that, timing doesn't matter, speed doesn't matter. You can spread out money over any period of time and you will always make
Always
returns.
make money.
That eventually we realized that was not going to
15%
work.
तो बन जाएगा.
इतना तो बन ही जाएगा. So we realized very quickly that it was not true, because when we sat with the data, so that's a good effect of this situation, is that we started seeing the data a lot more frequently, and that was the first mistake of not judging cycles right. The second part was about choosing what we really want. While we knew what return we wanted, we knew that there were multiple ways to get it. So we knew venture capital existed, we knew debt existed, we knew within debt there were multiple types of debts available also. But for a broad part, we knew we wanted equity. So then the question came about what combination sits right, because eventually most of them are giving you a return category you want. So that was a big mistake also, to figure out that any combination can give you these set returns over time. But then liquidity came into the play. So that's something that we did not initially factor in. And then there were products where there were some lock-ins, or there were products that had exit fees, or products that were returning capital in a staggered manner, which meant that my time value of money was getting lost. So a multiple bunch of these things came up, and we realized that these were some true errors that we made in judgment. But what really worked for us was that we caught on to those errors quickly, thanks to the team and thanks to the family being so super glued into the products, that we realized we want to switch up from this immediately and eventually move on to things that we're doing now. So
Yash, you spoke about cycles, liquidity, valuations. I think one very important part, the fact that now our investment universe is expanded just, across geographies, not just in India, across assets. So how do you define risk beyond just volatility or drawdowns?
with family capital, the risk is always a lot at a human level. It's not as simple as putting in a beta number to a portfolio and comparing it to a median risk of the market, and saying that we are equivalent or more. The real risk that happens is when things go up or down, especially down, is the conversations that take place in the family internally after that event has happened. Because what does tend to happen is that unless you don't have a pocket of risk, uh, when family capital goes into a situation like that, firstly, whoever has made the decision gets pulled up. And in that case, whether it's a next gen or whether it's a team or whether it's a combination of the two, and when that pull up happens, it puts you in a spiral of thought about why did you take a decision? What was the after impact of that decision? And then it leads to a conversation which talks about family risk. Most cases, the family risk tends to be the one of either the patriarch or the matriarch at the top. Generally, that's how we look at risk. But then what also happens over time is that as that risk evolves, the next gens and the team are able to take certain decisions that go beyond what was initially discussed. And again, that honestly is based on knowledge and the ability to perceive the volatility in an asset. But then you ask me about what is beyond volatility. And I think in a world like today, where there is tremendous geopolitical tension, and while the world has always had it, but the last 5 years have shown geopolitics has been a bigger role than ever. Currency risk has been a bigger role than ever. Metals, the kind of volatility we have seen. So, what's happening is the emergence of a new world order, and whether families are able to capitalize on that. And we can only capitalize on that when we know the risk is looking at things like currency, looking at things like geography, looking at how we want to spread our capital across the world. Because end of the day, why are we doing this? We're doing this because the family office and the investment structure has to outlive the generations that are currently involved in it, and it has to be able to provide a bigger platform for the future generations. And that essence really means that risk is every second, every minute. You're looking at risks of technology, you're looking at the risk of obsolescence, because what could work today may not
May
work
not
10
work
years from now.
tomorrow.
But then who's there to tell you that? Unless the family themselves are so aware,
In fact,
it's going to be tough.
sorry to kind of cut you in between, but I do feel the last few years is completely challenging everything we know about how we price risk in equity markets and
So true.
fixed income and
So true.
everything.
So true.
So,
I think when rules are getting rewritten and when
yes,
assets are getting retold,
yeah.
what happens is you either get lost in the storm, or you have enough data and awareness to sit down and rewrite your own rules. And that's the other thing that I've learned about our family office is we've managed to also rewrite rules frequently. Rather than just stick to something we decided 12 years back, we're able to sit down with data and use that data and rewrite the very basis on which we decided something 10 years ago.
Could you take some example?
I think equities is a lovely example. Equities was a place where initially we were completely outsourced, which we had outside products and external fund managers, which we still do, and we're very happy about it. I think we owe a lot to the products and the fund managers we work with that generate these returns. But in equity, what we realized is all the learnings that I took in the small and mid cap space, especially because 2016, I set up an internal portfolio to invest into small and mid caps alone. And all the learnings that we took from there today enable me to take a much larger risk and a check size, which would not have been possible 10 years back because I was not aware of how market liquidities work for these stocks. I was not aware of how the research is done. Um, but over time, we have developed some solid mechanisms to understand the business in, let's say, 3 days. And now we're able to attack stocks with a very different mindset. At a philosophical level, what for me has worked is I've understood what could go wrong. And when that knowledge comes through about what can go wrong, not much can scare you, apart from the probabilities you have already calculated.
So, in fact, Yash, you've partially answered the question that I had for you. That what signals tell you that a portfolio is well constructed even before returns show up in terms of balance, in terms of resilience?
Very interesting question. The way I look at a portfolio which can stand by itself. So, if a portfolio has been constructed with rules that you don't understand, and it's completely okay. So that's the first part. If a portfolio were to be presented to us as a family office and we did not necessarily understand the rules behind it or the mechanism behind it, but it was followed nevertheless, which means the discipline to keep that structure intact and do it, I would be very happy seeing that because it means that there is a different thesis at play. There's a different structure at play than what I do. The other thing that shows up about portfolios that are well constructed is over time, you can't backtest everything because if you start doing that, then well, it may present a false picture about
They
future.
say torture
So
data enough and it'll show you what you want.
yeah, and we love doing that in our line of work. We love playing with data enough to give us specific answers, but the real resilience of a portfolio doesn't even lie in the volatility. I think it lies in the fact that whoever made it with whatever thesis, it stands irrespective of the market.
But
It,
then
it
how do you
just
achieve that?
The best way to achieve that is by doing it the old fashioned way. What I do, I sit down with a paper and a pen and I write down the objectives of why am I investing into these 5 companies? Why are we creating this portfolio? Why must it have 20 stocks, for example? Or why must it have 30 stocks? And what is the reasoning behind my position sizing? And by the way, these questions sound really simple, but when you sit down and actually write the reasoning of why you're doing it is often the answer where it lies. People that are able to be bullheaded about their conviction. Of course, you could also be wrong.
Calculated conviction.
A calculated conviction I think that's a better way to put it for sure.
Okay. So, Yash, public markets is an integral part of most portfolios. Where, according to you, investors misjudge public market decisions? Uh, is it stock selection? Is it understanding cycles or is it largely behavioral?
I would say it's a combination of the three. What tends to happen is when you have seen a very solid private market return in many years within our Indian markets, we assume we can replicate the same because the reasoning to get into public markets is the same, that there's liquidity, it's listed, there's more information. But things also mess up here because stocks don't work for many, many years. We have examples of that in our portfolio. There have been certain stocks that I have done, small and micro cap domains, which do not provide necessarily the kind of growth that you might think in the next quarter. But the problem emerges is when I look at this space like a VC investor. I cannot, because when you're investing in public markets, I think most investors tend to get habituated to a high profile, a high risk and high risk, high beta return as well. And then when you look for exits or liquidity, you realize that there are equally important problems that exist in the public markets, which is that you either the volumes are not sufficient or you're not able to buy so much. There are multiple companies that investors might like today, but if the average traded volume of a stock is less than a certain number, you might not be able to buy a lot of it, even if you want to, even if you have the liquidity to. So that's a big mistake. And also, perceptionally, public markets are always seen as clean and neat and tidy. But if you see the spate of IPOs that have happened in the last 3 years or so, all time high for the Indian markets, can we actually say all of them have been extremely clean and extremely well tested and thorough? I doubt it.
So, if you have to give me a common red flag which you see across public and private markets, what is that?
Corporate governance and disclosure quality. I think these two are standard errors that happen in both the sets of companies. We have seen it at a family office level in certain companies where this disclosure quality and governance was not of the highest order, which we came to know at a later stage. In the last 5 years, there have been companies which I wouldn't name here, but have seen complete bust even in the public markets, high amounts of corporate governance lapses, and they might in fact be even more than the lapses that happen in a private company. So you can't really say what you know for sure, but all you can do as a good investor is track and make sure that there is no huge error that happens.
But let me dwell on this point. You spoke about corporate governance. Give us some hacks, Yash. Give us some of those easy giveaways where it becomes very easy to understand that यहाँ पे थोड़ा corporate governance हिला हुआ है.
So when something starts to get spoken about a lot, especially amongst multiple WhatsApp groups or friend recommendations or party conversations, for me that's a personal red flag. If that starts to happen, then I'm the first to be wary. Even if I hold that stock and this were to happen, I would revisit my thesis. The second part is the average number of shareholders that hold a certain stock. Generally, we have seen, not all the time, but generally, as that number also increases with time, not just the volatility, but also it shows you that it's a trending stock. What, as a family office, we don't want to get into a trending stock. We want to get into a good situation that grows a little slowly, but grows surely. The other hack I would say is in India at least, and in most parts of the world, nothing beats the power of network. So unless you're able to pick up the phone and speak to 5 people in that same industry and ask them a simple question, which I often ask them in Hindi, which is, "Sir, इस company में क्या चल रहा है?" या "मैम, इस company में क्या चल रहा है?" When I get answers like that, or when I get 6 or 7 conversations like that with people of one industry or from our market side, that creates a solid repository of information, and then I'm happy to go and check that with a direct interaction with a company or at an event. So a large part of my work actually involves having these conversations and making sure that we're collecting information the right way. Every time a research report cannot help, वो हमेशा help नहीं करता है. Due diligence reports always do not help, because how do you measure people? How do you measure the intent of somebody who is trying to create a new business or value? That intent can, two ways to answer that. It can be done with time and it can be done with patience. And you need to have both in abundance to do that. So I wouldn't say these are hacks really, but these are kind of, you have to, it's a must have if you're investing in this particular domain.
Yash, very interesting. You spoke about man, like whatever you spoke about. I think that's a lot of work. That's a lot of hard work, and that's a lot of effort. And I know that as a family office, you guys have been building your own investing aptitude as well. So, how do you balance between, if you see an opportunity, whether I need to now evaluate a manager, and whether I need to choose a manager, versus trusting my own investing aptitude and investing directly? How do you arrive at that balance, or like when do you tilt towards giving money to somebody who's managing it professionally versus just doing it yourself?
Yeah, very interesting question. One that we have dealt with now for almost 12 years. We, when we started out our journey, it was entirely outsourced capital to our external fund managers, products. The goal was simple. When we are not sure that we're intellectually up to invest something directly, we always outsource it, because we have seen that, like how the family built the business, when you have certain core competencies outside, why not outsource it there? And we were never averse to that. What we were trying to figure out was, where in that J curve do we lie? And what is the best way to measure that? Always numbers. So what I have to do, and in our family office, a very good practice that we do is every quarter we sit down which in case is me and my team, who are managing capital which is going into the mid and small and micro cap domain, we actually sit and have a conversation with the family committee like a fund, because end of the day it is capital and hence we're a fiduciary. And here we think it's our duty and our financial duty to report about what we're investing into, what went wrong, and if something went wrong, how are we working on fixing that and how do we find solutions, and if something is good, are we booking profits, what kind of liquidities are we creating. In many cases we have actually not needed liquidity because of the profit booking that we have done at the right time, taken money off the table and reinvested that capital. So that creates a good cycle of answerability.
Yash, one thing beautiful that has come out in a couple of your answers is the fact that you sit right, document. Basically, you do a lot of documentation of what you get into, why you get into, then monitor it and then review it. Which means also, in a way, you've institutionalized the entire investing process. For all the newer family offices which are listening to this podcast, how do you? What would be your advice to them in terms of how should they build such capabilities and where do they start?
So my advice for the newer family offices would be that do not confuse a single family office with an investment fund. Not every investment has to be done directly, and not every investment has to be researched by you, because the truth and reality of the world and the markets is that there are smart people out there looking at very good opportunities, and it's very crucial that returns don't become your only goal. We cannot only assume that a 3% extra delta every year is the goal of this family office. According to me, a family office is more a means to an end rather than the end itself. What I mean to say that is what I alluded to earlier, that a family office must create a conducive platform. It does not need to be the end goal for your day to day and your reason for waking up every morning. I think a family office should achieve certain financial goals, certain non financial goals. I meet family offices when I travel for events or for conferences who have completely outsourced their capital and they're very happy. And the reason that they're happy is because they wish to focus their time and intellect and resources on a different project. But that doesn't make them any less, because end of the day, many of their portfolios could be beating ones that are actively managed. So a couple of quick lessons if I had to give for the newer family offices. If you can't do it, outsource it. If you want to develop core capability, please measure it against what's actually happening in the market, because numbers are the god in our industry. The third part is family office has to go beyond investment allocation. You have to think about how are you going to bring in different generations? What are the goals of those generations? The fourth part is family office is a lot about soft skills. I think this is not spoken about enough in our industry. The ability to sit with three generations of a family and have a conducive conversation, which also creates a culture of open communication, is so important. And unfortunately, we don't hear much about this.
But how
because
do you do that?
how do we do it? Well, we have an outing every month where
Okay.
we travel, we go to our farmhouse, which is not too far away from the city, and the entire team sits down. And anytime that there is a heavy or a super difficult topic to discuss, we sit down there, everyone gets a chai, we sit down and we have a very open chat. Everybody gets at least 15 minutes to talk about their own part of the
Wow.
story. And this is not like a corporate practice or a boardroom practice,
But
but
still, it's
it's a
like a
culture.
calendarized event.
It's something like that. It's something like that. We also
Nice.
do team lunches every week. So in those team lunches, a lot of the routine daily stuff gets discussed, and we're able to make things move quickly. As a family office, we are quite flat structured anyway. So we barely have any layers between the family and the team. And in my case, especially, I'm hands on to it as well. Uh, so that open culture coupled with the team lunches and the farmhouse visits always help. We also plan some offsites, but again, the goal of those offsites is not always to have,
Just have fun.
yeah, you just want to,
Understand each other better.
yeah, you want to let your hair down,
Let-
right? And that's what I was alluding
Yes,
to
you
earlier,
were alluding to that
that the
earlier.
ability to have freedom within a confine and
Yeah.
then be able to get out of that confine with not just capital but also with intellect.
And in
I
an
think that's,
institutionalized way,
yeah,
which is amazing.
yeah, because without an institutionalized way, then what else is this? Then it's just four people sitting at a table, putting money in mutual funds or PMSs and talking about the returns every day. But in a family office, you have to think like a corporate boardroom.
Yeah.
And money comes with rules. Every penny that comes has to come with rules. It has to come with regulations. It has to come with a sense of answerability. So if you're not doing that, then I'm not sure you're running a family office. Then you might just be a really wealthy individual who's looking to allocate capital and do what they want.
So this is so beautiful and actually deeply philosophical, I must say.
Yeah.
See, while the last decade's been phenomenal from equity return
Yeah.
standpoint, but you just spoke about precious commodities, and what made you kind of think
Yeah.
of them as well. But in
Yeah.
that, with that backdrop, and with the fact that we see a lot of shifting geopolitical dynamics,
Yeah.
uh, would you like to elaborate a little more
Yeah.
on real assets? Like we
Yeah.
feel that the next decade could probably belong to real assets.
Yeah.
So, how do you evaluate that exposure for a
Yeah.
family office? What is enough? And say, many a times you might actually have an operating business, an underlying operating business where you already have that exposure,
Yeah.
right?
Yeah.
So, for somebody who has that exposure, how should they look at it? Versus, say, somebody who's had a, who's just running a family office, has
Yeah.
had a liquidity event.
Yeah.
They could look at it very differently. So,
True.
would you like to share your
True.
thoughts on this?
Of course, yeah. I think a big pattern that I've seen emerging is a lot of folks coming in from a fixed asset heavy business
Yeah.
or a fixed asset heavy mindset. They think that financial markets are the be all and end all
Mecca
of
of.
because it's liquid, it's growing,
Yes.
everyone's putting money in markets. But personally, for me, I have come from a family that has always appreciated hard assets, and in fact, this is something that my dad and I used to debate about. But I have to say that as a family, we've always believed in hard assets as a way to diversify and also create what I have now realized is a term called uncorrelated asset classes. And this uncorrelated asset class creation is something that I've observed over the last 9-10 years, seeing data of returns from land, returns from real estate, commercial yields, also with the way property prices in India have tended to go up. Now, it happens in a very different way. For a long time, we wanted to retain the flexibility of financial markets. So we kept a majority of our portfolios within financial markets. But hard assets create a beautiful uncorrelation to the markets. They create a beautiful lack of correlation to geopolitical events. And as we saw volatile periods, Yamini, we realized that we wanted to create a better base that could withstand also some shocks. But after that withstanding, then what? The big question was, can it actually give us returns? And very quickly we realized that with hard assets, there are very few periods somewhat similar to equities where 90% of the returns are made in those periods. And we have seen that personally in our portfolio with land purchases, with commercial properties. And while a lot of our colleagues and friends in the market were looking at financial markets, we were talking to real estate brokers and finding the next best property in within the vicinity of Bangalore or outside Bangalore. We were trying to figure out how to look at industrial land, looking at land for data centers. So a lot of the search is still ongoing. What I'm trying to say is that as a family office, we are not obsessed with only the markets or only having listed securities. Yeah, of course, now you have REITs and you have InvITs and multiple other methods to do it, but nothing beats the exposure to a good solid physical asset that can not just withstand volatility for you, but give you something which is much beyond the world of the financial assets, which is stable growth, which compounds over a good amount of time, and something that you can actually pass on to the next gen.
Beauty of tangible assets.
Exactly. And that's quite a beautiful thing to have in our portfolio. So while I'm a huge proponent of financial markets, it's something that I do 24/7, 365. But every time a discussion about a physical asset comes up, I'm the first to sit in the seat and get options on the table. I have also learned in this journey of how to evaluate physical assets, how to look at land, how to look at real estate, how to look at gold, silver, even with metals. I have to say that for a long time, while the world was making money with financial markets, the family kept a very stable mind with what we want to achieve with metals. And again, when I go back on my screen and when I see the data of metal returns, uh, I'm not trying to say that we were right or we were the first on the table, but I want to say that we had enough of a conviction to not let go of something because something else was doing well. So the ability to hold on to your thesis, and again, this alludes to the previous point I said about being bullheaded with certain reasons about assets. But long story short, Physical assets are always going to be important for us. And I don't ever see a scenario where we will liquidate physical assets to get into markets. In fact, the other way around could still be a lot more plausible, which is liquidating financial instruments to invest more into physical assets. Whether they are yield, whether they are capital intensive, that is questions for the future. But it is a very strong part of our thesis.
So, Yash, we've spoken about public markets, we've spoken about real assets. I want to take the next question about venture capital. You know, family offices often they do behave like venture capital investors, but in essentially they are not,
Yeah.
right? They're not VCs,
Yeah.
and structurally and behaviorally they are very very different.
Yeah.
How do you think families need to think about venture capital, and how do you think, like, what should be the approach that they should have,
Yeah.
especially when it comes to deal structuring of term sheets or governance? Um, it's very very critical to get that right, otherwise you could make some very big terrible mistakes when it comes to
Absolutely.
venture capital.
Absolutely.
So how do you look at that, because
Yeah.
you've been, like, again, you've
Yeah.
done that yourself as an investor.
Yeah. Venture capital is called venture capital because you're actually venturing into a totally new set of possibilities within the companies. And many of these companies are untried, untested, and what you're betting on is a lot of potential. And the problem that happens with family offices is that you, unlike a typical VC fund, don't have a timeline that you're adhering to. And that also means that there is no liquidity pressure on the family office, or there is an urgency on the family office team to create liquidity in 10 years from a particular investment that you have done. Family offices might say that they're willing to take write-offs because that is the nature of venture capital investing, but that's not why we're doing it. We're doing it to find those 3 or 4 outcomes that can really move the needle. But when you reach the outcomes in those 3 or 4 investments, what happens then? Do you have the means? Do you have the team? Do you have the intellect to go out into the market, fetch a buyer? You might say that if an asset is doing well and if it's, if it's grown tremendously, or if you've invested, let's say, 5 or 10 crores or 20 crores into a startup that has become a 10x for you today, do you have the ability to sell it? Because if you cannot sell it, then it's just a line item on your book, and it is the same as another company that may not have done anything at all, which may have been a total write off. Second is, can you track the company progresses and governances as well? Because unless you have a consortium, unless you have a very large VC fund umbrella under whom or alongside whom you're able to work, although that doesn't tend to happen, but for most of the family offices that I know, VC investments are a way to gain exposure to what's going on in the world right now. And I see that increasingly with strategic bets being taken. So, a consumer family office is likely to do a consumer deal. A tech family office likely to do a tech deal.
Yeah.
When we started out our journey, my first area of search by default, because of our family business, was building materials. Not a lot of people know this, but initially when I started investing, I was looking at building materials, but then I also decided to look into drone tech. Why did I look into drone tech? Because that was my personal thesis. But the area of familiarity was to work with consumer discretionary companies. But the drone tech bet that we did eventually did pay off. Now, I'm not saying that that one deal defines now that we are a master thesis of a tech fund
Of identifying
or like a
what's going to do well, the next multi-bagger.
yeah, we can't put our heads on a table and say we're experts in this. But yeah, what I have realized is with VC investments you have to be measured, and cutting 50 checks a year, unless it's some really big objective that you have of incubating businesses or eventually acquiring them, I'm not sure if it's for everybody.
Spray and pray doesn't work.
I'm not sure. Personally, I could be wrong, but I don't think it's for everybody. VC funds can do that because timeline, structure, thesis,
It's the
everything
nature of their
is,
business as well,
it's their business.
and they have that bandwidth.
Yeah. And they're living it day in and day out.
True.
Now, I'm not saying that a family office team does not have a capability of it. I'm sure that there's some very, very astute investors in this
Yes.
domain for VC.
Yes.
But do you have the right vehicle? And what are you actually trying to achieve? Is it an initiative of the team or is it an initiative of the family office?
Also, I think
Right?
at what size?
Yeah.
At what size of
Yeah.
the entire corpus do you actually start doing this,
Yeah.
like a VC firm?
For sure. For
I
sure.
think that's very important as well.
Yeah, I mean, unless you're not demarcating that I will do X percentage
Yeah.
for spray and pray, even if you want to do it. But even if that question is answered, how are you going to operate those investments? Who is going to be looking after it? I've seen that when investments don't go well or when exit cannot be found, most people don't answer the call. So who gets the owners then? Is it the family or is it the team who got the deal or who sourced the deal for you? So deal sourcing is very important. Where you're getting it from, who you're talking to about it, what is the vested interest of the parties that are involved in it. Of course, there are some equivalently amount of good people out there with great intentions to make money, but with a family office, eventually that sword is going to come on the family or is it going to come on the team? And if you don't have a team, is it going to come on the person who brought you the deal? But the person who brought you the deal may not be talking to you after things have done bad, or they might call you more if things have done well.
Doesn't it
So
also happen that sometimes what comes to families is a lot of rejects from larger
for
VC
sure,
funds?
for sure,
I think you should talk about it for since you've been doing this for the last
yeah,
15 years. I think
yeah.
you should talk about that.
We have a running joke within our family office investor community that if it's come to us, then it's definitely been rejected by a lot of people.
Yeah.
We go in with that assumption, Yamini, and I'm humble enough to admit that a lot of deals that have also come our way have been a lot of companies that have been recycled or rebought 4-5 times over 3-4 years. And by now we have built up enough of a network and the ability to find out where that deal has come from and why has it come. Now, I'm not saying they're all bad because eventually a business could surprise us. Something might do well.
True.
But for the large part, we have figured out what we want to do and avoid. So we go into all of every deal with a lot of skepticism in general. But why only every VC deal? Even public market deals I view with a lot of skepticism in general. So that's my mental model where I let the skepticism guide me towards rationality, and then that rationality to guide me towards a good investment thesis. And it's always helped me in the last 7-8 years of investing. It has helped me a lot. It has helped weed out a lot of things that look good on paper, but when the moment of truth arrives to realize an exit or to get a situation. But I could also say that the ones that have worked out for us have worked out because truthfully we didn't have to pay too much attention to it. Counterintuitively, a lot of people
You
think
want to
that
talk about your winners?
oh, for sure, for sure. We've had a few portfolio companies where the assumption is that because you're an active family office, you're meeting them every week and every month. But the reality is that the really good companies, you don't need to meet every week or every month because they're just busy executing. Two of our portfolio companies in the consumer space have showcased that in a good and bad time, we didn't have to call them at all. I mean, at best, we got a report. One's in the grooming domain, the other is in the pet space, and the third is in a related tech, the drone tech company that I told you about. And the reality is, I haven't spoken to them every week since. Once in 6 months, we've caught up. And the best thing you can do as an investor then is to sit back and just watch it unfold and keep the red flags in your mind because
These
it
are
can still go down.
examples of buy and forget.
Yeah.
Very rare,
Yeah.
but good to know that.
Very tough thing to do.
Yeah, very tough.
One of my favorite investors, he had this quote which he mentioned about the best investments don't happen when you meet the management or when you're in their face all the time. They're just busy executing, they're building,
Absolutely.
and you're sitting back. But also sitting back requires a different kind of knowledge. I've realized that. Sitting back, I used to think 7 years back meant that you're just shutting yourself out to a lot of noise and ignoring. But sitting back actually means listening more. So when I'm sitting back and I'm listening more, I have these 6 KRAs that I have set in my head for every stock or every investment that I make. So even when I'm quiet or when I look at my team and say, guys, we have to
Talk about those 6 KRAs if you can.
Yeah, sure. So, 3 of the 6 KRAs for any stock or investment are to do with business. So, for example, if it is a glass business, then the glass production growth, the volume growth, and the expansion capabilities, and then, of course, the promoter. Certain metrics around tracking the governances. The remaining 3 are market forces. What is the ongoing price if I were to go and fetch for sale for it in the market? What are the risk factors which could affect it outside of its own business? Maybe it's a supply chain issue, maybe it's a geopolitical issue. Right now, the trade tariffs happened, and we had a few companies in our portfolio that underwent a difficult time. But the first assumption in that situation was not that it's going to end and things are all doomsday and everything. I just sat back. In fact, the next 2 days I didn't go to office. I went to a coffee shop where I wrote down these KRAs for each stock and I thought about it with a cool mind that are these things being met or not. If most of them are being met, I'm not going to get moved or swayed by it. So those KRAs are to do with business and the market together.
So that's a blend of micro and macro.
Yes, a macro blend together, and also with some parts of our thesis. So we have a certain thesis where there are some parameters at a number level. Every time a result were to come out or something were to substantially change, I would run that screen again. But again, it's not as rigid as that. Not everything comes through a screen or parameters. There is some element of a gut and a hunch, and that gut and a hunch for me has only come with time. I don't think 12 years back I could have sat and said that I know what a gut feeling is.
Gut and hunch only gets stronger with practice. And the
Yeah.
more you are aware, the more you know.
So true. So true. There have been times I've faced volatility in certain investments. We had done a trade in silver this year when the prices were just about to rise. And at that point of time, me as a next gen and also a fiduciary managing the family office, I wanted to put a pretty substantial sum into a silver trade. So you can imagine the kind of questions and the kind of the volatility that comes with a decision like that. But truly, my guts were tested because the day I did the trade, the next day silver fell 10%.
Wow.
Which I had no clue about. It just shot up like a random attack, and the next morning I remember waking up and my mentality, my gut, everything. I actually woke up. I was like, is this the right way to approach this? Have I put the right sum? Have I done the right research? And after a few hours, I sort of acclimatized to it. And the gut feeling that you were talking about, at that point of time, I just stood and looked myself in the mirror and I said, look, I know why I'm doing this, and I know that these are the 4 points. So it's like an internal conversation with yourself. Even before anybody else asks you about कि आपका silver पे क्या view है, कि आपका gold पे क्या view है, you need to be so clear first. And then, of course, fortunately, the trade played out for us very beautifully. But it could have also gone the other way. And if it did go wrong the other way, I had a mental model ready for that also.
Nice.
That I was ready to accept what may have lapsed in the thesis or thought process. But even though the trade went well, we didn't come out saying that now we're a metals expert and now we'll do everything in metals and make money in metals. We were cautious enough to realize that it's a certain situation that has arisen. And situations come and they go.
Yash, one very important question. You know that investors across the globe actually suffer with home bias. And that's not very different for Indian investors as well, though it's now changing a lot. And capital is going global as well. So, with that backdrop, how do you adapt your investment portfolio across geographies? What are your thoughts on international investing?
Yeah, look, I agree. The home bias does exist.
Yeah.
There is this inherent need to talk about the story which is in India, and there's been a great narrative. Last 12 years, the narrative actually has been really strong as well. Having said that, the first cracks that emerged for us in that home bias thesis, because we ourselves had it for almost 5 years of investing, we were not thinking so deeply about US markets or China. We were tracking it, we were reading about it in newspapers. But for me, the first crack emerged is when I started to attend a lot of the global investment conferences abroad and meet other family offices and investors who look at countries like stocks. That really opened up my thought process on figuring out that why are we not as a family office looking of diversifying our risk, and क्या सिर्फ इंडिया में रिटर्न बनता है? That was a big question that I came back with. And I remember sitting down with our investment committee and telling them this exact sentence that I'm telling you now, that is India the only place in the world that returns can be made? And there was a resounding, no answer to that. The next question was, if not India, then where? Because then you were comparing economic growth data, GDP data, inflation data, you were comparing central bank policies. So when we did all of that, we realized that look, the story is still great here. We'll keep a majority of our assets here because we have a better sense of things. But my submission to the family and to the investment committee then was that if we don't start now, then we will never really truly understand what it means to be a global family office. The one that has seen risk emerge at a global level, whether it's geopolitical risk, whether it's economic risk, whether it's currency risk, many of these things which you had asked me earlier as well. So, global investing for me is like looking at each country like a stock. So, when I look at the MSCI EM index, for example, where India currently resides, and then there's of course multiple indexes that represent the world. The first observation that I have is that I'm now looking at India as a stock. Earlier, I was looking at India like an economy and the story and companies, but now I'm looking at it like a stock, which means that if I have this stock, I have to have a diversified portfolio. I have to get exposure also. The second part of that conversation was what themes are we playing? So if we're going to China, and now there's talks of massive investments happening in the AI
AI.
ecosystem there, and that economy has been in a very slowed down growth phase for a long time. So if somebody asks me today where I might put my money for the next 7 years, I might actually say let's look at a China, or
Yeah.
let's look at a certain South Asian economies that have continued to rise on the back of supply chains, whether it's in textiles or semicons or prefab products.
In fact, emerging markets have done well recently as well.
That's so true, and we've seen a complete reversal. The U.S. growth story was very much intact, and in fact, with the change in the Fed governor as well recently, and with the jobs data coming in again pretty strong, there could be a whole reversal. So it seems to me that there is also a big shift that is happening from one economy to the other, and you can imagine how difficult it is when you start investing globally, that you have to measure multiple data points. Now, it's no longer just about 10 stocks or 10 mega caps in the US that are determining the whole world, because the next set of mega caps could be emerging from any of the other countries. And in this case, with the way the new world order is evolving, it could come, it is definite that it's going to come from this side of the world. The question is when. So, when I go into it with that thought process, my immediate thesis is that look, when we are in India, what are the themes that we're able to play? So there are sectors and subsectors, many of them. But for the large part, India still has a lot of traditional sectors that are contributing the most amount to the economy, whether it's capital goods, whether it's consumer
Oil
discretionary,
and gas.
banking, NBFCs. They're contributing the maximum to our value as a stock. So as India as a balance sheet has this on their paper. And when I go out as an investor to events across Southeast Asia or the West, different countries are creating their own growth levers now. So if someone wants to do AI, India may not yet be the best place. We may
True.
have things developing in the next 5 years. In that case, you might want to get an exposure to a different economy. Once you go into that economy, if you want to do active stock picking, then you have to understand it probably as well. Again, it doesn't mean that just because you're a family member, just because you're sitting with liquidity, you can just start picking six things and just put your money in it. It has to be with the right research. And when I look at the world as an investor, I look at it as a place where I want to not just diversify my risk, but also play the best themes which give me the most bang for my buck. And that can only happen when I'm in the right place at the right time, and also because it's public markets for the large part for us in the right cycle. And if we can achieve this, then I'm by default also getting my currency risk diversified, because when I'm investing in certain markets, my currency is getting
True.
converted. If I'm booking profits, if the currency were to depreciate, I make a double gain. But again, these are all afterthoughts. You never invest with currency depreciation in mind. You're always thinking that the asset will do well.
True.
So that is a big part of it. But the other problem that again, this leads to another problem, because when you start to create investments in other countries and other markets, that capital grows with time. That has a very high potential of compounding, which it will for the most part, and create another very large corpus there.
Mm-hmm.
Now, when that large corpus gets created there, it's a domino effect. Now you have to structure that.
Yeah.
Now you have to figure that out, rebalance that.
So, but do
And
you have some
you know,
percentage in mind? Like, do you have some minimum threshold in mind that, okay, this should be your international exposure?
oh yeah, for sure. So we have a certain number in our head. For us, it's 10% of my total equity
Okay.
portfolio. It at a cost level that always has to be invested into non-INR and non-Indian stocks together. And when that happens, I know that I'm definitely diversifying to the level that I want. When that 10% goes up to 20%, whether we will book or not, there is no specific answer, because we are very dynamic with the markets.
And then there is also
So
tax
it's
implication.
yeah, that's a big setup, and a lot of that gets answered in the structuring.
True.
But again, conversations on structuring are so important,
Yeah.
because it's not just 4 members in a family or 10 members in their wealth. You're also thinking about eventually where and how those funds are going to be moved. So in our case, we have kept the structuring very, very simple. It also helps that it's a nuclear family, so by default, structuring becomes easy. But I always implore other family offices during conversations that think of investments, think of returns, But the after effect of that investment and capital becoming large in other jurisdictions, how do you want to link that up? Because wo headache ek na ek din aayega. The reason I call it a headache is because you will have to liaise with the right set of people there, local lawyers, local practitioners. Your team then has to be capable enough to have a conversation with them. This part no one talks about because everyone's so focused on returns. No one thinks that this one small puddle is going to become a pool in that country, which is not your home country. And you might go to that country only for a holiday. You might not go to it for work. But now you're forced to factor that into your Excel sheet line item. And this also means that your family office MIS that you're tracking, every week, every month, you now have 5 new topics to talk about and track.
Wow.
So this part and this domino effect is not thought about by most people because everyone, and we're guilty of that too. There were times where we have happily invested just for the sake of that additional return. But there was a point where we paused and we said, 1 second, hang on. There's a lot that we're doing, but now we need to collate everything. The back office of a family office over here is so important. Without the right back office and the right tracking, you might be the smartest investor, but you'll be the worst family office investor.
Oh,
And I
this
think
is
that is a
so
big
critical,
question.
not spoken about at all.
Yeah.
Back office.
Yeah, and this is so crucial, Yamini. We've for a long time kept at the very heart of our thesis a good MIS and a good back office. We don't talk about it a lot because unfortunately conversations are dominated by what's going on in the market,
Yeah,
which
returns.
stocks are returns, right? So now we have reached a stage where we kind of want to make this the central theme of our journey.
Okay.
And whatever we diversify into, so we've reached a stage as an institutional setup, we've reached a stage where now we can do, I have the flexibility as an investment manager for the family office to do 5 new markets without it ever burdening us at a tracking level or at a reporting level. And also, it helps because I'm involved in it myself. But if I were to not be involved in it, if I were to be out somewhere for some other engagement, that data, those line items would be taken care of. And I think this is probably the most underrated part of running a good family office setup is how well you're tracking it. Because if you're not tracking it, you may as well just be an individual investor, go and base yourself, get a nice office, invest alone, invest individually. But when you're doing a family office setup, it's going through multiple entities, multiple jurisdictions. There are various tax implications. Some countries have DTAA agreements, some don't. Some countries have zero tax on capital gains, some don't. Where you want to structure, very important. Um, Many family offices don't structure because of the market, but because they want to be around other family offices who have structured there so that they can share ideas. Now, I'm not a large proponent of this, but I always say that your money should always be in a jurisdiction that is absolutely crystal clear to understand. Whereas you, as a person, can be in any part of the world if you wish to live a different life, base yourself somewhere else. But the family capital has to be in a perpetuity mode, which means that you can never take your eyes off the ball. It's like watching a tennis game, but you cannot stop watching the rally. But at the same time, there's a football game also going on, which is interesting, and you're putting a bet on a football game.
Wow.
So now, when you win a bet in that football game, your attention should not turn to that football game. The tennis game is still going on. So I think this is a best example that I can give for a good example of family portfolio management versus your active investments. And I think that has to
Tracking as well as benchmarking,
Yeah.
everything.
Right.
This is very useful, Yash. You've touched upon very important nuances which actually nobody talks about. So thank you for that. And it's been lovely having you on the show.
Thank you so much.
And I'm sure a lot of our family office listeners will find a lot of value in this interaction with you. So thank you so much for your time and thank you for joining us in Inside the Family Office series today.
Thank you so much for having me, and I wish you guys the best of luck.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.